Everyone, welcome. You are watching News 9 Live and our continuation of our budget programming leading up to the presentation of Budget 2024. We here at News 9 Live have kicked off our pre-budget programming, and in this special series that we are calling Budget 2024 Blueprint for the Big Leap, we will outline India's economic priorities reflecting Modi administration's goals and addressing current challenges and how the Budget 2024 is set to deal with it. And in this edition, we're focusing on India's fiscal deficit target. The government achieved a fiscal deficit of 5.6% of the GDP during the previous financial year. And for financial year 2025, the government had pegged the fiscal deficit estimate at 5.1%. Will the government scale down its fiscal deficit target to 5% or less in the upcoming annual budget? To understand that and more, joining us on the show today, we have Gauri Chadda, Tax and Wealth Management Advisor. Thank you, Gauri, for taking time out to be with us. We also have Mohit, co-founder and CEO, Moneyfront. Thank you, Mohit, for taking time out to be with us. I'm going to begin with Gauri. Simple question over here. Fiscal prudence is going to be crucial for any budget, going forward, keeping in mind the levels at which inflation is going and the importance being placed on reining in inflation, isn't it?
See, definitely, I believe it will be the government will be focusing on the fiscal deficit for sure. But as far as I understand, the government cannot just only focus on the fiscal deficit, rather than it has to make some arrangements for the taxpayers as well, and maybe reduce the tax rates as well. So I think it's a very crucial budget for the government, where they have to cater to both the things, where the fiscal deficit is a big challenge, and of course the taxpayers also are demanding a tax rate cut. So I am hoping that both of the factors are taken into consideration, and a balance is maintained.
Balance needs to be maintained. Mohit, talk to us. We're talking about a target that was set in the interim budget. Are you expecting a refreshing of that target in terms of fiscal deficit?
So look, I think honestly, what this government has done very well till date is to stick to fiscal discipline. Look, 5.8% was the target. We've come in at around 5.63, which is a massive, massive improvement over what the government set out to in last financial year. This year, I think in all likelihood, the target will be at 5.1. I'm not pretty sure whether the government will revise it further down, because government have had some largesse from the RBI dividend. So government has the headroom in terms of perhaps reducing the fiscal deficit, but my sense is they should not actually go all out on the fiscal deficit. A little bit of deficit is good, because they have to focus on more infra development and few other priority areas of the economy. So my sense is if government can loosen the purse strings a little for this financial year, they have the headroom, they have the leeway, going by the good dividend from the RBI and great tax collections. It's already evident from the GST numbers which we have been seeing. So my sense is the legroom and the headroom is there. But will the government reduce the target from further from 5.1 further below? I honestly doubt that. I think government will stick to that number and perhaps spend that money wisely into more capital formation or into more infra related sectors, and perhaps maybe go a little more populist in this budget.
How do you envision the government going more populist, Mohit, if you can elaborate on that?
Look, honestly, I think this is the first budget which this government will give as an NDA government. Till date, we've had a single party budget. This budget will be more marked and pronounced in the form that it's predominantly a coalition budget. And what has happened in the election is that the government has gone through a little bit of a shock, right, in terms of the mandate in which mandate which has come through. So my sense is government might have to look towards the agrarian distress, would have to look towards the farm sector, will have to go towards more job creation, which will mean loosening the purse strings, right? So which might just mean some amount of prioritization of the agrarian economy, putting the farmers at the forefront, trying and giving more freebies perhaps, or subsidies in a slightly roundabout manner. So I can't rule out any of these, and my sense is there would be something for the rural Bharat, so to say. Till date, the budgets have primarily focused on the India story, which is the more infra development, the more highways, roads, ports, airports, so on and so forth. This might just be the budget which takes you from India to Bharat.
Okay, okay. Gauri, let me bring this question to you. You were talking about taxes. Of course, there's lots of expectation on, will the income tax rate be rationalized in the upcoming budget? What changes will be brought to the new tax regime, or will more exemption be given under the old tax regime? What are your expectations, on that front?
See, I believe that of course, the tax rates will be cut, and of course, the government cannot focus on the old regime because in future, I see that there's a plan of fading it out, and eventually that will be abolished, so the focus will remain on the new regime. And the tax rates, of course, in past budget, not the interim budget but the budget before that, was like rationalized. The slabs were rationalized, but the still, I think only 50-60% people are benefiting from the new tax regime. So, to in order to make it more lucrative and to make 90% at least people cover in that, I think the new regime will be made better. Because apart from that, I think government doesn't have any access scope for the old regime, because if they focus on the old regime, then it means that they will carry on with that regime, which I don't think is going to happen. So I believe that in this budget there will be a major change in the new tax regime. If not, then maybe if not the slab rates, then maybe maybe the standard deduction is increased or something like that will happen, which will benefit the new regime opters.
Right. Mohit, I'm going to stick with that question on income tax rates. What are your expectations?
Look, to be very honest, as much as personally I would like it to be revised, right, been made more friendly. I honestly doubt government will tinker around with the tax rates. Though I completely agree with Gauri on the point that government will continue its nudge and push towards the new tax regime. So perhaps maybe a goodie here or there could be sprinkled in the new tax regime. I would be extremely happy and delighted if they pass on the housing benefits which were given in the old tax regime, which is under ATC, or perhaps the housing loan interest component had an extra deduction which was available. So if they could give that in the new tax regime, it serves the government two good purposes. One, it makes the new tax regime extremely attractive for people to adopt quickly. Second is that they in turn they will have to boost the housing economy, right? The housing sector per se is the biggest employment sector in the country. So for government to create jobs, which is the thrust of this budget in all likelihood, government will have to push the real estate sector. And for the demand to come through, they might just have to give out some goodies or will have to dole out some kind of tax rebates in the budget so that the people also incrementally start purchasing houses for their end consumption, right? So I would be personally delighted if that happens. Having said which, I think this government will directionally keep moving towards the new regime and will keep pushing investors or keep pushing taxpayers towards the new tax regime, because that's finally a step towards the DTC, which is what this government wants to happen. So I personally don't expect too much to happen. However, if something comes through, it'll be great.
Okay, if something comes through, it'll be great. But let's talk about other taxes as well, Gauri. All the other direct taxes. Look at the number of taxes that the average Indian is paying these days. Apart from the income tax, there is the, capital, long-term capital gains tax or the capital gains tax. There's the securities transaction tax. Even if you save that money, whatever income you get after all the taxation, and you invest it, you pay a tax on that. What are the kind of relief do you think is possible and should be done in the upcoming budget?
See, as far as long-term capital gains and short-term capital gains are concerned, I believe that in terms of equity, uh, we might not see any change, because already the rate is at 10% only, and that was also introduced in 2018 only, because before that there was no tax in equity. So on long-term equity, so now that they have given a rate of 10%, which is the lowest, I would say, and apart from that, they are giving 1 lakh profit exemption also. So I don't think that we will see any change in that. Probably, if there's a change, they may increase the 1 lakh limit to 2.5. lakh. That's it. I don't think so any rate cut in that case would be there. Apart from that, the other long term assets are charged differently. All long term assets have different period of holding, like property has 2 years, and gold and other long term assets have 3 years. So in that case, I think people are demanding some kind of rationalization where there is in all asset classes, there's a symmetry that if holding period remains the same or tax remains the same. Although I believe it's not possible right now, because every asset class has a different calculation, and they have much more involved in it. But definitely the demand is there to simplify the tax structure in terms of long term and short term capital gains. Apart from that, the indexation which has been removed from debt instruments is a big setback for the people who invest in debt instruments. But again, I believe that this might not be touched in this budget, because that was also very recent change. So I don't see any major change happening in long term capital gains or short term capital gains, apart from the fact that there may be change in holding period or something like that.
Okay, Mohit, your thoughts, apart from income tax, the other taxes that the average Indian ends up paying, all the direct taxes, what are your expectations from budget 2024 on that front?
Look, to be very honest, I think for people like you and I, honestly, there should not be any requirement of filing taxes. Virtually every single thing which we do, every single expenditure is tracked by the government. All capital gains are tracked by the government. Salary income is tracked by the government. All bonuses, every other thing is out there as information available with the tax authorities and with the government. I should just be going, filing a declaration and clicking yes and submitting my tax, and everything should be auto done. I would want to see that kind of digitalization to make the life of an average taxpayer, and there are handful of us who are actually paying reasonable amount of tax in this country. Basically, I would want to see that ease of filing taxation to be completely given out, and perhaps the elimination of a chartered accountant for require from the requirement of filing taxes for a normal Indian. To me, I think that'll be the biggest win this government can achieve. As long as tax brackets are to be changed and some whatever rebates up and down, honestly, I'm not so much fussed about it. My sense is government might just not tinker about anything. Right, on capital gains, the thing which Gauri mentioned, I think rationalization across asset classes is of prime importance. Today, every single asset class is taxed very differently. Gold is taxed differently if it is in a mutual fund format, if it is in a physical format, if it is in a SGB format. All three taxes are different, right? Property is taxed differently, unlisted equity is taxed differently, listed equity is taxed differently. So my sense is some amount of rationalization in the holding period and the definition of what is long term, what is not long term, and perhaps trying to see whether indexation can be brought back in some form or manner. Look, debt as an investment class has become extremely unattractive for investors, and which is also one of the key reasons why this massive equity rally is getting fueled on, right? Because people are finding extremely low interest in fixed income instruments these days because of the taxation change and because of the no indexation benefit. So my sense is in some form or the other, incentivizing the debt investors or the fixed income investors or the retired investors and not pushing them to change their risk profile and kind of nudging them towards equity. Something will have to be done, whether it's getting back indexation in some form or manner or changing the definition of the holding period or getting in something, right? So I think a lot of rationalization across the capital assets is required as a category.
Okay. Let's shift focus a little bit. Gauri, I want to talk to you about the corporate tax in India. Corporate tax in India is at 30%, and there's an additional surcharge on it as well if your revenues, if your income is between a certain limit. Are you expecting changes on that front? And more importantly, do you think there should be changes on that front?
See, I believe that the corporate tax rate is actually now lowered, because earlier it was, of course, 30%, then they've lowered it to 25, and there are cases where you can pay 22 and 15% as well. But as far as the LLPs, partnership firms, and sole proprietorships are concerned, they are still taxed at 30%. And I've been repeatedly saying that this needs parity, because companies can't be paying less tax. I understand that the economy is run by corporates. I definitely believe in that. but these corporates are paying salaries to the employees. They are claiming deduction on that salary which has been paid to the employee. They are also paying lower tax on the profit, but the employee who is drawing the salary is paying tax at maximum tax rate is 30% plus cess, and in a few cases surcharge as well. So in this case I believe there should be some change. This is the reason why I always say that the income tax rates for the individuals should be reduced, because you can't tell people that if you want to do business, you should form a private limited company rather than going for a sole proprietorship firm or a partnership firm or LLP. There may be cases where people want to go for less compliances, they are just starting their business and they might grow over the time, but you can't expect them to form private limited companies initially because they want to pay less tax. I understand that the individual tax rates are at slab, but the highest slab rate is 30%. And people who are earning in, above 50 lakhs, I would say they are paying maximum amount of tax, because basically they are paying surcharge, and above that also, because surcharge has its own limits, it keeps increasing. So basically the people who are earning more are paying, the people who are drawing salary are paying more tax than the corporates. So in this case I believe that there should be a change. But as on date I believe that maybe the tax slabs are rationalized, but I don't think so they will be in parity with corporate tax rate. Corporate tax rate is definitely on a very lower side, which of course has given boost to the economy. I have no doubts in that, but still I think both the aspects should be looked into.
Mohit, your thoughts on corporate tax?
Look, I think the corporate tax rates are at great level, honestly, and further reduction just might not be possible for the government. I don't think so. The government has cushion to further reduce it. They've gone all out, honestly, to promote that corporate culture, and government has been quite hungry in terms of getting the corporate to start putting up expansion projects, manufacturing setups, and everything, so as to incentivize more job creation and corporate capex in this country. How do they go about doing that? I think tax is not the only mechanism of doing it. My sense is perhaps introducing PLI in some more sectors, which is an indirect way of incentivizing the corporates to set up more manufacturing, or perhaps giving some additional benefits in to set up manufacturing facilities in other remote areas and all those kind of things. I think that is what government should adopt to, and will perhaps is what government is likely to do. Whether the rationalization will happen on the private limited and LLPs and sorry, the LLPs and the partnership, I think that will be a good step in the right direction. Perhaps the rates on those entities also could be brought down the way it has been brought down on the private limited companies or public limited companies. However, honestly, my sense is government has to incentivize the corporates more on setting up new plants, boosting up manufacturing capacity and more job creation. So I'm not sure what methods government will adopt for that, but that has to be the end goal.
Okay, I'm asking all these questions because to shore up India's tax collections will be an important factor when it comes to achieving that fiscal prudence and fiscal balance. Even as there is chance to expand the government's spending.
Oh,
Mohit.
definitely. Look, so I think every penny collected is a penny saved, and government will have to shore up its fiscal balances. But my sense is, as I said at the start of the show, that government is fairly comfortable in terms of its fiscal position today than what it was many years back. And I think Indian government for that requires all the praise to be given to them, because they've managed the fiscal position extremely meaningfully. Even during the COVID time, India was one of the countries which didn't go all out. Bursting out of proportion in terms of fiscal imbalances. So my sense is government has the leeway. As I said, they have good amount of largesse from the RBI this year, and perhaps if they focus more on disinvestment and some divestment plans and other things, I think government will be able to mop up good amount of money. So I don't think so. Raising taxes is the only measure. Perhaps giving more incentives to set up more manufacturing and to increase production, I think, and also to drive consumption. I think that's going to be the thrust area.
Okay, we'll leave it at that. We're completely run out of time here. Mohit Gang, co-founder and CEO of Moneyfront, thank you so much for taking time out to be with us. And of course, Gauri Chadda, tax and wealth management advisor, thank you so much for taking time out to be with us here on this pre-budget special here on News 9 Live. And we will be continuing with our pre-budget programming all the way up until when the union budget is finally presented on the 23rd of July. Make sure you tune in to News 9 Live for non-stop live coverage of Budget Day. But for now, we wrap things up on this edition of Budget 2024 Blueprint for the Big Leap. I'm Krishnakumar signing off.